central banks around the world are looking to buy more and more gold over this year and the coming year. They've been buying over 1,000 net metric tons a year for the last 3.5 years. And yes, they're abandoning the dollar as not completely, but they're hedging their bets with gold because gold is not political. Gold cannot impose sanctions on you like the United States and Europe as well, for that matter, have been doing, especially to Russia in the last few years. So I think gold and silver and commodities are still the place to be in the medium to long term.
Asia is steadily moving away from the US dollar as geopolitical tensions, monetary realignments, and growing interest in currency diversification fuel a broader de-dollarization trend across the region. The Association of Southeast Asian Nations has recently reaffirmed this shift by including increased use of local currencies in its 2026 to 2030 Economic Community Strategic Plan. The goal is to facilitate trade and investment within the bloc without relying on the dollar. MarioInnecco of the YouTube channel MarioInnecco64 notes that as BRICS and other Global South nations deepen economic ties and prioritize local currency transactions, demand for US dollars, and by extension, US Treasuries, will weaken. This is evident in the behavior of central banks, which have been purchasing more than 1,000 tons of gold annually, favoring it as a neutral, sanction-resistant store of value compared to dollar reserves. At the 2025 BRICS summit in Rio de Janeiro, Russian President Vladimir Putin confirmed that 90% of transactions among BRICS members are now conducted in local currencies, with a significant share settled in rubles. In response, President Trump issued a warning that any country aligning with BRICS' anti-American policies would face a 10% tariff, without exceptions. This trend poses challenges for the U.S. Innecco points out that fewer international buyers for treasuries could prompt U.S. regulators to ease leverage requirements on banks, allowing them to absorb more government debt. However, this strategy risks injecting more liquidity into the financial system, potentially reigniting inflationary pressures. While countries like China, Japan, and the UK did offload over $80 billion in treasuries in late 2024, the broader sell-off narrative remains mixed. Still, if higher interest rates become necessary to attract buyers, it may force the Federal Reserve to pivot from tightening back to monetary expansion. In such a scenario, assets like gold, silver, and commodities would likely benefit significantly. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Many people have dismissed the BRICS, that it's not important. But for Trump to be concerned about BRICS, I think it shows that it is important. And I think this is going to act as incentive to the BRICS nations and the rest of the world that's trying to join BRICS to de-dollarize even more. They're going to say, we can't really depend on doing trade with the U.S. if they're going to be that difficult. And Trump also noted that the BRICS are anti-American, and I think that's wrong. They're not anti-American. They just want to have a bigger say in what goes on in the international financial architecture. And what do I mean by that? Well, they want a reform of the IMF, and the biggest gripe of all other countries, with the exception of the U.S., is that the U.S. is the biggest shareholder in the IMF, and their shareholding gives them a veto power. Anything that the IMF decides can be vetoed by the United States. And the BRICS nations, of course, they're now like 40% of the world's GDP, 45% of the world's population. And the U.S., of course, is not as strong in terms of population nor GDP. So I'm not trying to defend the U.S. nor BRICS nor criticize any country here. We're just looking on this channel. We just look at the facts and the numbers and how it's going to affect not only the BRICS, but also the U.S., Western Europe, the U.K., where I live. Of course, right now I'm in Switzerland for the holidays. I think the technical picture for bonds, they don't look good, as I said earlier, but also all the fundamental aspects are building up in order to hurt the U.S. Treasury bond market. And why is that? Well, I think the countries that are in BRICS or trying to join BRICS and other countries in the so-called global south, what they're going to do, they're going to try to become less and less dependent on the dollar as a reserve asset for international trade. They're going to try to deal more and more. Pakistan and another country like Malaysia, when they're gonna try to use their own currencies. The other thing that we're seeing and is going to continue, because we've seen various surveys from the World Gold Council and other institutions, that central banks around the world are looking to buy more and more gold over this year and the coming year. They've been buying over 1,000 net metric tons a year for the last 3.5 years. And yes, they're abandoning the dollar as not completely, but they're hedging their bets with gold, because gold is not political. Gold cannot impose sanctions on you like the United States and Europe as well, for that matter, have been doing, especially to Russia in the last few years. So all the talk of punishing countries that deal with BRICS, or even countries that are in BRICS, I think is going to have the same impact that freezing Russia's assets, foreign sovereign countries, more and more into gold as a reserve asset. They're going to look more and more into dealing with other nations without the US dollar. And what that's going to mean is that they're not going to have as much dollars to park in the Treasury market. And that's another reason why U.S. banking regulators and the U.S. Treasury are pushing for the loosening of the statutory leverage ratio, or SLR, for the major U.S. banks, so that they can load up on more treasuries, because Uncle Sam, of course, has got trillions upon trillions to refinance. And if they don't find a captive buyer, rates are going to have to go higher. Yields are going to have to go higher. That's how you attract buyers in a bear market, if you can. Some people might think, well, they get rid of this SLR. They'll allow the major Wall Street banks to buy loads of bonds. Yes, they could do that, but what that's going to do as well is that's going to free up a lot of liquidity, which means more currency out there floating around. It's going to be even more inflationary. So I could see it backfiring. And I guess one thing that they could resort to, especially the Federal Reserve, is to not more QE, because right now they're doing QT. They'll have to stop the QT and then start QE again. But that's going to put a rocket up gold, silver, and all other commodities. So I think we're going into some very interesting times. And not that it's going to be great for everyone. Unfortunately, the people who are going to suffer the most are going to be the poor, the lower quintile of income earning people.
Despite President Trump's repeated calls for lower interest rates, the Federal Reserve remains cautious. Uncertainty surrounding tariff policy has made officials hesitant to move quickly, with many citing the unpredictable economic impact of ongoing trade disputes as justification for maintaining rates steady. Nonetheless, Goldman Sachs has begun to shift its outlook, now anticipating that the Federal Open Market Committee could begin cutting rates as early as September, with further normalization expected through 2026. This expectation has added fuel to the rally in the S&P 500, which could continue if rate cuts materialize. Since returning to the Oval Office, Trump has consistently pressured Fed Chair Jerome Powell and the FOMC to lower rates from the current range of 4.25% to 4.5%. His stance reflects a broader push to stimulate the economy ahead of what could be a challenging period of global economic realignment and domestic policy shifts. MarioInnecco of MarioInnecco64 warns that if the Fed yields to political pressure and starts cutting rates, it should not be seen as a vote of confidence in the economy. On the contrary, it would signal concern within the central bank about underlying vulnerabilities. Innecco advises investors to closely monitor the bond market and the yield curve, as both can reveal early signs of financial stress or shifts in sentiment. A move toward easing would likely have reverberations across markets, with potential implications for inflation, currency strength, and safe haven assets such as gold and silver. Let's get back to the interview.
I think this tariff war, this trade war, could evolve into a kinetic war. And I think that's the way things are going. We're seeing already in Europe as well that major European countries like Germany and even the UK are talking about increasing government spending, fiscal spending. Yes, they've got Russia as a threat, right? I don't buy into that, but that's the narrative they're using. The U.S. is using the narrative that China wants to invade Taiwan, which I think is hogwash. But yeah, they have to convince the domestic voters that that's the right thing to do, that we have a threat. But deep down, the reason they're doing this is that this fiat currency system that's ballooning and mushrooming since 1971 is coming to a juncture where if they don't keep inflating, it's going to collapse. But the only downside to keeping it going is that our currencies are going to be obliterated. They're already being obliterated. And unfortunately, it's going to hurt the most vulnerable in society, the great majority of the middle class and lower classes. And I think it's not only dangerous in terms of the geopolitical kinetic war situation, but it will create a lot of tension domestically. I mean, there are people talking about civil war in the UK, and that the UK government is using the Russian narrative to prepare for it, only because they can't say that the general public in the UK is getting fed up with all the inflation, with all the taxes, right? And the same thing for the US. It's always the foreigners that's the problem. And yeah, in the UK, they're even talking now about wealth taxes. You know, that's going to come. They want to tax the people who pay the most tax even more. The problem with what's going on is not the wealthy are making people poor. It's the governments and the central banks, the banking sector, who create the inflation. They're the ones who make the general public poor. The multi-millionaires and the billionaires get richer is because they can protect themselves. So by punishing them, you're going to make it even worse, because people are going to leave the UK even more. They're already leaving the UK. It's going to disincentivize the private sector even more. So they always do the wrong things. So as I said, I'm speaking on Monday, and you're going to be watching this on Tuesday. But I think the bond markets don't look good. I think it could spill over into the stock market, in that we could see the stock market kind of top. Yes, a melt up is still possible, but yeah, there's something brewing in the system right here. And of course, the Fed only meets at the end of the month. We could see them cut rates and start cutting more. I think the Trump administration is really pushing Jay Powell towards rate cuts, and we're seeing some other governors calling for rate cuts. And that doesn't necessarily mean things are great. A lot of times when the Fed starts cutting rates, it means that they're concerned. So watch out. So right now, for example, we saw gold and silver get hit pretty hard earlier today on Monday, but as I speak here, it's like midday New York time, 6 p.m. Swiss time, and gold is still it's down 0.5% at 33.21, but it traded as low as 32.96, so it's recovered. Spot silver traded as low as 36.14, but we're now at 36.70. So I think gold and silver and commodities are still the place to be in the medium to long term. I see the stock market, the rally we saw earlier today has fizzled out. The Dow futures is basically unchanged. S&P is up about 14 points. And the NASDAQ 100 is up about 60 points. And as I said, the bond market, as I speak here, the 30-year yield, for example, is at 4.92. That's up 6.5 basis points, which, yeah, isn't a great move, but it's a significant move on a day where things are pretty quiet. But as I said, the curve is steepening because the 2-year yield is up only 1.5 basis point. The 10-year yield, that's up 7 basis points at 4.40. So we need to keep an eye on that.
Central banks continue to play a pivotal role in supporting gold demand. In May 2025 alone, they added a net 20 tons to their reserves, with Kazakhstan, Turkey, and Poland emerging as the top buyers. According to recent surveys, 95% of central banks expect global gold holdings to rise, and 43% plan to increase their reserves, a record-high figure that points to a significant shift in global reserve management strategies. Over the past 3 years, central banks have added more than 1,000 tons of gold to their reserves annually, far exceeding historical averages. This steady accumulation is widely regarded as a key driver of gold's price strength, even as its correlation with traditional assets, such as bonds and equities, has weakened. Beneath the surface of international finance, a quiet rebalancing is underway. As emerging economies increasingly favor homegrown currencies and solid assets over reliance on the dollar, the architecture of global reserves is evolving. What was once a system anchored by unquestioned trust in U.S. financial instruments is now being reshaped by geopolitical pragmatism and diversification strategies. Gold has re-emerged as a monetary cornerstone, while central bank policies and political pressure threaten to collide with market realities. Investors, meanwhile, are watching for early signals, rate pivots, debt absorption tactics, and institutional gold buys as clues to what lies ahead. Is the world witnessing the beginning of a new monetary order, or just a temporary reaction to short-term pressures and policy shifts? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.